The following is an excerpt from Equity Crowdfunding, The Complete Guide for Startups and Growing Companies by Nathan Rose, narrated by the author. What is equity crowdfunding? Right from the start, it is important to clear up the difference between equity crowdfunding and rewards crowdfunding, as this is the single biggest point of confusion among those who are new to it. When most people hear crowdfunding, they automatically think of the type offered by sites like Kickstarter and Indiegogo, without realizing that crowdfunding is a much broader term, of which the Kickstarter and Indiegogo variety is but one type. One reason for this confusion is that businesses can attract money through either form. The fundamental difference is backers of rewards crowdfunding campaigns are provided with a gift, such as a product, digital download, or experience, in exchange for their pledge. Whereas investors in equity crowdfunding get shares of ownership in the company itself. There have been well-known rewards crowdfunding campaigns which have raised eye-popping sums. For example, the Oculus Rift virtual reality headset garnered $2.4 million from early backers in 2012 through Kickstarter. The backers of Oculus Rift helped the company get its start, and yes, the backers were duly delivered the virtual reality headset they were promised. But when the company was sold to Facebook in 2014, these backers were only customers, not shareholders. Had Oculus Rift instead been funded through equity crowdfunding, the ones who contributed the money would have shared in a $2 billion windfall. That's billion with a B. Therein lies the difference. If an investor puts money into an equity crowdfunded company, and the company does well, then they stand to profit. The implications of this distinction are profound. There is also a difference between equity crowdfunding and the stock market. On the face of it, again, the two can seem similar. Both are offers of shares in a company to the general public. However, equity crowdfunding is handled through an online platform, without the need for brokers or the stock exchange. Another difference is that raising money through the stock market requires doing an initial public offering, which means preparing a prospectus, which is a very long and prescribed document requiring lots of input from expensive lawyers and investment bankers. Equity crowdfunding is therefore simpler and less expensive than an initial public offering, and within reach of companies at an earlier stage. So, equity crowdfunding generally has four aspects to it. Number one, offers via an online platform. Number two, to the general public. Number three, for the equity of startups and growing companies. And number four, with reduced disclosure obligations compared to listing on the stock market. This marks the end of the free sample of Equity Crowdfunding, The Complete Guide for Startups and Growing Companies by Nathan Rose. To continue listening, please purchase the book on your favourite audiobook distribution platform.